loaded up. So if there's any questions on why is a stock behaving a certain way, I can look at a fundamental analysis as well. But yeah, I don't really have anything else to say other than there's no stupid questions, and just don't be afraid to ask questions, because there were people from previous Zoom calls that I were going over things, and it was kind of like, because I used to teach college math, college finances, college economics, as well as high school, and sometimes you just get that dead stare where it's like, yeah, I understand, but if you don't ask the questions, you can't understand it if you don't if you don't ask. So just don't be afraid. Or if you want to type it, I have the chat open as well.
Yeah, either one. So feel free to jump in or raise your hand or just put it in the chat. I think we can just go down in order. I know some people are still logging on. I just got a message that says I never got it. So
I'll throw out a question.
Okay, what's up, Jamie?
So I signed up for the newsletter. And so when it just talks about the option calls, just understanding what it means and like what steps people then normally take to place an option call, because I've never done option calls before. And so I've been trying to understand and follow with what the discussion during the week, but like just kind of a simple scenario of how you guys would actually go about looking at it. And I've looked at some of the charts for the options, but still trying to get the basics.
Yeah. So do you understand anything about options trading at all?
A little bit. So I started watching, there's the 3 videos, like an hour and 20 minutes each.
Yeah.
So I've gotten through the first video, and I'm still going to watch the second and the third one.
Okay. So and I'm going to let Chris speak on this, but one of my big things is with options, people always, it's just such a big thing to tackle because you don't take it step by step. So what I talked with Chris this morning about was we will really only put call options in there. So you're going to technically be buying and selling the contracts. You're never going to exercise the contracts. You're never going to buy or sell puts, at least for right now. We'll take it a step-by-step process. That's almost like kind of dumb it down, because when you look at it as a whole, it's very confusing and there's so much to it. But Chris can kind of jump in here. He has a good way of explaining call options that I think, but really I just want to focus on you're physically buying and selling the contracts. You're not actually exercising them unless certain scenarios, which Dan can touch on. But Chris, do you kind of want to jump in and try to give a low-key answer on call options?
Yeah, let me pull up. Can you make? Oh, I can share my screen. Okay, yeah. Perfect. Okay, give me 1 second. Okay, so I'm gonna share. So I'm just making sure. Can everyone see this?
Yes.
Okay. All right. So let me get the draw. Oops. So let me go to trade. Oops. Hold on a second. So basically, when we talk about options, the first thing to know is it's a contract. So there's 2 kinds. So options. Oops. 2 kinds of options. There's a call and there's a put. So a call is the right to buy a stock at a certain price, at a certain date. Okay. Most, and I'd say 99.9999% of options will expire on a Friday. The indice options, which is SPY and QQQ, those can expire Monday, Wednesdays, and Fridays. But so just so you know, is generally they expire on a Friday. It's the 3rd of Friday, but there are what's called weeklies. But let's just do the basic. And so then there's a put, which is the right to sell a stock at a certain price at a certain date. So when we talk about options, it's the same. So because just you've probably heard people like to go long, meaning they purchase a stock in hopes of the stock going up in price to sell at a later date, or you can short a stock, which is essentially telling your broker, hey, I want to buy this stock, but I'm not comfortable with the price. I think this stock's not going to do well over time. So what they do is they find that stock and they kind of hold it for you for that price. And then over time, you would, if the stock were to go down, then you would buy it at the lower price and then you net the profit. That's kind of roughly what it is. But just with options, these are contracts, and the lots, meaning the size, is in 100s. So that means one contract is 100 stocks. So let me actually show you oops, let me change that. I thought it was going to show me how do I select that? Connor, do you know how to do that on Zoom?
I don't.
Uh-oh. Okay, let me,
You just type a new one to the side.
okay. I usually use my smartboard technology. So, oh, the select tool, maybe that's what it is. So I'll do white. Okay. So when you look at, so generally, if you want to put it in a different term on like, what does this mean? Let's just say, go back to the 1970s when there was an oil shortage, and there were even cars lining up for gas, and there were, based on your license plate was when you would get when you would be able to get gas. So a good analogy with that is perhaps someone new in the oil sector or the energy sector. Hey, we're looking, and I don't know the exact I know some economic reasons on why, but they're thinking, hey, oil's not looking too good during this time period. So you know what? I'm going to buy some contracts right now. And what these contracts do is it says what I stated down here. It's the right to buy a stock, or in this case, I'm talking about oil, at a certain price at a certain date. So when I look at that, let's just go with the oil. If oil is at, and I'm just using just simple math, if it's not draw, okay. So if oil, let's just say it's at $10. And you bought a call for $10 to buy it at $10 for today's the 13th, so let's just say it's for January 15th, and you paid $1 for it. So basically that means is you paid $1 to buy this contract, to buy oil for $10 on this date. Now, what's nice about American options is you can exercise them whenever. European options, their expiration is, you can't expire, but I won't really go into that. But in case anyone is in Europe, that or whatnot, and talks about European options can only be executed at that time. So let's say oil jumps to $13, and that's on the 14th, so that's tomorrow. For whatever reason, there's tension in the Middle East, oil's going up. Okay, well, let's look at that. I have this contract to buy oil for $10, but oil's at $13. Well, you have a legal contract, kind of like if you make a gentleman's agreement or even a sales agreement to purchase a car or oil or anything at a certain time, then they have to honor it. It's a legal contract. And so what that means is at the end, so if oil continues to keep on going up and it comes January 15th, then and it's still at $13, well, that means I actually own $3 extra for oil, or per oil barrel. Now, why is that? Because there's multiple strategies for investors. This is one of them. And so, but there can also be losers there's winners and losers on all investment ends. But when you look at that with the call is, let me get the highlighter. So you have the right to buy, oops. Why did I not do that? Okay. You have the right to, does that highlight on your end? Do you guys see that?
No, I don't.
No? Okay. So you have the right to buy for $10, but it's at 13. So in math terms, that means you made $3 per stock or per oil contract. That's essentially what a call option would be. So when we look at options and calls, you're what's called bullish, meaning it's going to go up. So bullish. Okay, and I'll go over the puts first, but I just want to do the calls. I see there's a question. If I never this ended as green, oh, okay. I do see that, Jared. So just give me a second. But and just in regards to just explaining what a call option is, are there any questions on understanding that, or anyone else want to add anything? No.
And one big thing I do want to point out here is that with the options plays that we do, and most of us that do trade options, we are technically just buying and selling the contract. We are not exercising them. Okay. So in his situation, you have the right to buy the barrels of oil or whatever oil for $10, and it's now worth 13. So the premium you paid for it is what you paid.
Right. Yeah.
And you can sell it for a higher premium, and that's where you get your money from options.
Yes, right. Because I didn't want to really go into break even or anything, because I just first wanted to get the general gist. So Jared asked if you never sell the option and if it's green and profitable. So with this example for the oil, you bought that $10 contract, but you paid $1. So essentially you would have what's called a break even point. And your break even point is going to be the break even point, price you pay for premium, add the strike price. So the strike price is going to be what your amount that you're saying you want to buy it for. So let me actually use a real example so you can see. So I'm just going to look up. I want a conditional.
So while you're looking that up, Marcel asked, why not exercise? Why sell the contract? Because when you buy, or when you actually exercise the contract, you're still having to buy it. You're gonna, and this might not be a great answer. So Chris, you might have to here.
So the question is if why not exercise, why sell? So there are things, because if for example on the 14th, so tomorrow, it's at $13. It realistically, there's no crystal ball. So technically this contract, you may, at the end, it may be $3 for your break, or $3 for your break even. But if this goes up more, then this contract's going to be worth more.
Yeah.
And then over time, it's called what your delta is. So if you've studied mathematics, delta generally means change. Change in velocity, change in money. Your delta V. So your delta price, the option will generally go up further the more it goes, but then it hits a peak to where the amount will only change by one, meaning $100, and I'll kind of go into that in a little bit.
Dan, were you going to say something?
Yeah, I was going to say something. So I think we need to take a slight step back. So let me give everyone some history. So like historically, the way that traders used to use options, and let's use commodities, for example. Let's say I'm buying commodity on corn, right? And because I think in 10 years, the price of corn is going to be very, very, very high. But I, as a farmer or supplier or whatever, want to be able to buy that corn at a lower price. So I'm going to buy a contract we'll just oil, because Chris used oil. I think oil is going to be trading at $50 a barrel, but I want it at $10 a barrel. So let me buy this contract right now, for like 115, 2040, right? Let's make that the expiration. That way, when 2040 comes, if oil truly is trading at $50, I now get to purchase that oil at $10, and I'm sitting on a $40 profit per barrel. But I'm doing that because I deal in oil. I have to supply oil. I want to get my oil at a cheaper price, versus like paying exorbitant amount for the oil. So that's why I'm buying the contract. So historically, contracts in this case were used, like option contracts were used for that manner. Recently, in that, yeah, I don't know how many years passed, but like people are speculating on it, which is what we're talking about right now. Like we're betting on a price movement. So we're going to speculate that it's going to go from there to there. So we're going to buy the contract and then resell the contract for that premium, that higher premium to make money. But to your point, I think Marcel asked, why not exercise? If you actually wanted to own the asset, in this case, the oil example, I as an oil trader need the oil because I have to supply that to my manufacturers and whoever. That's where I would want to exercise it. But I would want to exercise it at a lower price. So I'm not paying the $50 per barrel 10 years from now. Same thing holds with stocks. Like let's say, I'll use my favorite stock, Connor's as well, Palantir, right? Right now, Palantir is fairly cheap compared to what it's projected to get at. People are projecting like it's going to hit 100 in a couple of years. We'll see if that actually happens. I hope so. We'll see. But if it's going to hit 100 in a couple of years, I'd rather own it now at 10 versus paying $50 a year from now as it makes its way up. So I'm going to buy a contract now at 10 while the premium is still relatively cheap because the price hasn't made its movement up to 50. So let's say the premium is like 6.5. So really I'm owning the stock at $16.50 per share. And then if it ever hits 50, by that expiration, I get to buy that stock at $16.50, but now it's trading at $50. So, I mean, you see the profit potential there, right? The difference. And so I would, if I'm not speculating on a contract just to buy and sell for the premium, and I'm actually trying to own the stock, but I don't have the cash right now to pay outright. So I want to buy the contract to own it at $10 down the road when I do have the cash to buy 100 shares per contract for the stock. That's when I would want to exercise it.
Yeah.
If that makes sense.
That makes a lot of sense for sure.
Yeah.
So, and then there's a couple other ones that we can just touch real quick. What if the oil never hits $10? Did you just lose the contract cost? So with that, the most you could lose is the premium you paid for it. If it never goes above $10, then it expires worthless. You lost your premium. And that's it. Like you could only lose the premium when you're buying calls. Whereas the other options, like if you're selling puts.
Well, let's go into this. If you actually own the stock and the stock goes down, let's just say for Apple, for example, Apple right now is at $130.89. So if you bought 100 shares, because each one of these contracts are in lots of 100, so you put out $13,000. Well, if Apple drops to $100, you've lost that $3,000. Whereas if you were to actually purchase perhaps a call option, thinking that you want it to go up at a certain time, then that's why you just trade the contracts, because that way you put up less premium or less money in that case, but you're hoping it's going to go up. So that's kind of why some people do that. So when people deal with options, they're not actually trading the stock, they're contract traders. It's just another product in the stock market. There's many different products. There's even options on the volatility on the actual market, or there's options on the indexes or the indices. Sorry. Yeah. There's Chris, on currency. There's everything.
When you get into this explanation, and you're looking at it now, that's why I'm interrupting you. What's an example of a cost of a contract? And he's looking at it right now, so I figured that would be a good time.
Okay, I made the font a little bit larger, so I'm just choosing Apple, for example. Let's just say tomorrow, Steve, or no, I don't even know the spokespeople. Let's just say Apple expected to say something amazing. Elon Musk also tweeted it. Okay, gotta have some humor in there. All right. So if you see something like that and you're like, oh my gosh, I need to buy Apple right now, even though you can't, it's been 24 minutes. But so when you look at that, you're thinking, oh my gosh, Apple's going to go up. Well, I don't have $13,000 to dump onto Apple, so I could just I can buy an option. I just need to know what I'm doing. So when I look at that, Again, one contract is 100 stocks. That's what's important, because all of these values that you see minus IV. So let me type that so you can see it. So all values seen minus IV, open, interest, and volume are multiplied by 100. So now there's different things. There's bid, midpoint, and ask. So with stocks, there's a bid, which means, hey, I want to buy it for this amount. Okay, just think of it like an auction. I mean, stock market is like, it's an organized auction. You know, there are people saying, hey, I want to buy this for, so I'll just look at, let me make this a little bit larger so you can see it a little bit better. How is the view on there? Do I need to make it larger, you think?
No, you're good, I think. If anybody doesn't like the view, say something in chat.
So let me actually change just so we're looking at one so you guys don't get all confused. Strikes, we just want one. Just want one. Okay, and I just want this. Oh, come on. All right, let me actually make this bigger since I only have one. It was so much easier on the smartboard tech, but so we have, oops. So we have the change, the bid, midpoint, ask, theta. So again, just going back with the car instance, you have your bid, meaning, hey, I want to buy this call option for 0.77. So that means I'm going to pay 77 cents per stock. So because it's in lots of 100, so my premium is 77 cents per stock. However, it's with 100 stocks, so your bid is going to be 0.77 times 100. So you're going to pay $77 for Apple 132 call for January 15th. Oops. Okay, and then your midpoint would be 0.78. Your ask, that means that's what people are saying, hey, I'll sell it for this much. So when we talk about the difference or the spread, this spread is very, very close. So midpoints is generally auto-calculated for you, because you could say if this was 77 and 79, the midpoint would be 78, obviously. If just like with car auctions, if someone's offering $77, but someone else wants 79, generally, I'm a man of business. I would meet in the middle. So more times than not, if the spread's pretty close and you have a midpoint, then it will likely fill. I'm not going to say all the time, because sometimes the algorithms, they kind of move, and I can go into more deep talks about that, because I've definitely tried to move things on purpose with another account to have them fill. That's called hedging, but that's what that means. So I paid $77, and that means I have the right to buy Apple at $132 on January 15th, because Apple's going to say something amazing. So let's just say what happens. So I'll do green, because we'll say green's the future. Oops. So Apple hits 140 on the news on their big 6G network. Also cures diseases for whatever reason. So guess what? You can still buy that app. You have the right to buy this Apple at 132. And so just basic math, I made $8 per stock, which would be $800. But because this is an option, there's what's called time value, and also there's interest. But I don't want to go into that right away. Sorry.
Your attack dog over there?
Yeah, they're two little 5-pound dogs. but just in basic terms, you can make $800. Now, for the contract traders, you spent, so when you think about cost opportunity, you spent $13,000 of equity, and or I'm sorry, $13,200. Let's just say you bought, or whatever, 13,000, because it's 130 times 100, so there's 2 extra zeros, but so you put that much out. But I could have bought this call for $77. So if I really wanted to, and I wouldn't say gamble, I would say make more of an educated guess financially based on what you know about Apple, what you think, you could buy more of these calls and they would be worth more. So in terms of cost opportunity and how much you put out versus what you get out, this may be a better option. No pun intended. But I don't even, that's probably why they call them. No, but I'm just going with the jokes. But that's what that would mean. So another example, let's do something a little bit larger. So if I look at Amazon right now is at $3,165.89. I think there's something great going to happen with Amazon. So I could pay $20 per stock to buy it at $31.75. But remember, this is in lots of 100. So this is a $2,000 option. Now, with options, though, there are some risks because you don't own that stock. So just kind of going back to Apple, since this is a call for January 15th, that means you have the right to buy this at any time between when you buy it till the end of the day of January 15th, which would be 4 p.m. Eastern time. So if this doesn't hit 132, this option, why would you want to execute a contract to buy it for $132 if, let's just say, Apple's at 130 right now, or on the end of Friday? That wouldn't make any sense. So that's what you would call expiring worthless. So kind of like a vocab term, and I'll do red. So expire worthless equals contract hit date, did not hit price. So that means you lost $77. So here's kind of the caveat with options versus stocks, or whether or not you look at it either way. You could have lost $77. However, if you bought the stock and you put out the 13,000 and it drops on Friday, but then there's bigger news over the weekend or on Monday, well, you could have made more money on that too. Whereas you'd have to re-enter into the next week for Apple. Now, when we look at that, though, there are different times. There's different time frames. So I'm just going to change it. You can see, I don't know if you can see or not, but you can do options all the way up to 2.5 calendar years. I think it's, I forget the actual amount. It's like 8. So to buy one for March 17th, 2023, 135. So this is to buy Apple at 135 in March of 2023. You're going to pay. So it looks like the spread's not too bad. So the midpoint's $27.50. So that means this option would be $2,750.
So with longer options, obviously you have much less time for the stock to reach that point. So you're going to pay a much higher premium. On the last example, it was 77 cents per share. Now you're looking at $27.50. So $77 for $2,000 option, but you have so much more time. Okay. Yes. That's where you've got to make these decisions on, do you think it's going to reach there or not? By that time period. So weeklies, like he was looking at, where it ends at the end of the week, you wake up on a Monday morning, there's one that expires on Friday. Those are called weekly options. Those are going to be much more risky than these long-term options, but they're going to be way less expensive because of that risk. So you have to kind of weigh it in your mind. Is it worth the risk, or do I want to go less risky and just spend more money? That's really what you want to decide for yourself. Like, we tell you what to do in the newsletter and stuff like that, but at the end of the day, it's your call Like you'll see what comes in the newsletter. I might buy something a little bit different than what Ken has in the newsletter. I might buy an in the money call or something like that, or something a little bit longer or a little bit shorter,
Yeah.
just because I think it'll move by that time or won't.
Right. Yeah. And people always ask me, well, what option should I buy? And this gets into a little bit more. There's all different strikes. There's different strikes for this. Let me move this.
So, and real quick, Jared said, so can it expire with value? If you say
Yes.
forget it to sell it or no one buys it. And Dan's answer was, yeah, some brokerages have it set up where it will auto exercise the option for you. If not, if you don't have that set up or they won't do that, then you just lose. It expires worthless.
Right. Well, if it's in the money, it will trigger an auto command. Kind of like the broker will say, hey, this option's considered in the money. You know, what does the individual or the account holder want to do? So you'll get an email, and I'm not sure in terms of how it works with different brokers, but the broker that I'm with right now, if I hold that option it's until 4 p.m. Eastern time or 2 p.m. Arizona time right now, it'll auto execute at 2 o'clock, because that's when the market's considered closed. The normal hours are closed, and I own that share at 2 o'clock, or I'm shorting that share at 2 o'clock. And so in terms of, you know, what you want to do, you hold that stock. So if you want to sell it in what's called the after hours or pre-market hours, you can do that. Or some brokers may actually sell the option. I think it's maybe some do. I've heard Robinhood does 1 hour before. I'm not sure if that's true or not, but someone said 1 hour. It could be 30 minutes. It could be even two minutes. It will auto liquidate. So now if it's worthless, then it will just expire worthless unless you do something. But then the chances are, kind of like with the car auctions, if you're selling, let's just say like a junker, like the Cash for Clunkers junker, you may not find someone that even wants to buy it for a penny. So that's what people do, is they let them just expire worthless so they don't have to pay the commission costs for options.
So one thing though that everyone should be aware is, even if a option contract expires worthless, it doesn't necessarily mean that no one will buy it. And I'll give you an actual example that happened to me last week. So I sold contracts, covered calls on Palantir at a 26 strike, and the stock was trading below 26. So I was basically just trying to capture option premium to generate that income. And I knew it wasn't going to hit 26 by the expiration, which was last Friday. Saturday morning, I wake up and I get a message from my broker saying your option has been exercised, meaning, and I don't know why, but whoever bought my contract decided to exercise it at 26, even though the stock was trading at 24. I don't know why they did that, but they did that. So I was out several shares, which I basically just rebought back in on Monday because the price was still below 26. So it worked out for me, but it can happen where the person, whether it be you or if you're selling calls, the holder of your contract decides, you know what, I want to exercise this anyways, even though the option is out of the money. Just be aware that it can happen. It doesn't typically always happen, but in my case, it definitely happened to me. So just want to make that aware. So it's not a for sure thing that it won't get exercised if it's out of the money, but it could. And
right. Yeah, that's true. And the CBOE, they randomly select who gets assigned. It's not first come, first serve. So if Dan were to have sold these, so selling options, I don't really want to go into because, so maybe I need to also say one thing before people do it. If you buy an option, you need to select. So to buy an option, you want to select buy to open. If to sell an option, sell to close. So what Dan's talking about are two different things. What he did was he sold to open, then they exercised, so he couldn't buy to close. But these are for newbies or intermediate people, these are what you want to select. Buy to open, sell to close. Otherwise, you're doing a whole different risk on that, because, so like for Dan's example, because he had to buy those shares at that execution price, but he could just buy them for shorter. So he collected that premium, and he also was able to get the same amount of shares for a lower cost price. But when we're talking about just simple options, buy to open, sell to close. If you do the opposite, you have what's called unlimited risk, and that's because when you buy something, think of it like a debit card. If you buy something with a debit card, it takes money out of your account. But if you use a credit card, you can keep swiping that thing until they finally say, hey, you got it, you reached a limit. Just like with your account, your debit account, but then again, you're more careful with your debit card or your checking account. But kind of going over, I'm just looking to see if there's anything. So again, going kind of back to if things are expired or being assigned something, most of you, unless you're actually selling options, which is completely different than what we're explaining here, you won't have to worry about being assigned. Assignment risk is something that people look at, and other math stuff, which I'll go into more detailed webinars. But this is just, if you put out, let's just say if you want to buy an Apple call for 132, thinking that maybe Apple will go up to $132 by Friday, you're only putting out the price that you pay, which would be whatever this dollar value is times 100. So if our example was 77 cents, 77 times 100 is $77. So when we talk more about the strategy behind it, you kind of want to also look at your break even. So the break even was the price you pay and the strike price. So if the strike price was 32 and you bought at the bid price of 77 cents, just to get an idea, you want it to go past $132.77 because you paid, think about it, you paid 77 cents per share to buy it at 132, but you want to make money. So that's why if it does go past 132, then these options the premium starts creeping up. They're a little bit higher.
But one thing to say here, it does not have to hit your break even for your contract to start gaining money. Okay.
Yes.
So that is a big thing when you're just looking at buying and selling the contracts itself. Before it gets to 132.77, your contract could be worth money to you. So you could technically sell it before it hits break even for a profit.
So for right now, it's at 130.89. So let's just round it to 131. If it hits tomorrow to 132, then I know based on what these other numbers are telling me, this contract's going to go up $36. So this would, just simple math, this would be about $110 minus what's called theta. But I don't want to go into most of the other stuff. I just want you to know, if you look at your strike price, that's what you're going to buy it for, what you're going to buy the stock for, and if you generally just if you simple math it, okay, can it hit 132.77 by the end of Friday? Yeah. So even if you're not at 132.77, this call may still be worth more money, because if it's not till the very end of the trading day, they're still taking into account more of the probability, could it go up or could it go down? And that's how some of these prices are determined.
Does this make sense to everybody? If there's any questions, feel free to throw it out there, put it in chat. You can unmute yourself. John, I think you were saying something. You wanted to?
Oh, I guess I saw people using some acronyms, some other things to look at. If you see what's called OTM, that means out the money. So it's not at the price yet. There's ATM, at the money. So it's at the price. Oops. And then there's ITM, which is in the money. So it's beyond the price, or past it. Maybe not beyond there, just put past it. So what I mean by that is, if I wanted to identify, let me get to this and let me do different colors. So if I look at out the money would be anything that's past what the price of Apple is. So so these, anything below these, I'm sorry, anything past 130 is going to be what's considered out the money. At the money, that's a good color. At the money, that's going to be where it's at. So it's at technically, I'm going to say it's 131. So that's where it's at the money. That's not a good color. Sorry, guys. Nope, I'm not going to use that color either. There we go. And then there's in the money. I'll just do green, I guess. That means it's past it. So since these are past my purchase price, or the price that it's at, that's why these cost more. Now, some people say, okay, well, why would I want to buy some of these? I'll go into that maybe a little bit later because I still want people to just grasp what a call option is. But essentially, what these mean is it has more, I guess, more pizzazz to it, I guess you would say, because if you buy this contract for 124, obviously you're not going to pay, $119 for it. It's generally calculated close to where it's at in terms of in the money, because if you do 124 plus 7, that's 132. So you would technically be almost at your break even point.
So Chris, there was a question in here
Oh,
for the
sure.
Apple example. If it hits 132 before Friday, is it good? Or Friday at close, does it need to be at 132?
If it's at 132, depending on your broker, it may actually execute. If it's below 132, this would be very minuscule. It'll show maybe like a cent, which means it's $1, or $2 maybe. I don't know if you'd be able to sell it, but once it goes past that 132, then yeah, you'll be making money. But the closer you get to the closing time, that value is gonna exponentially decrease. Because if you think about it, if you were to think about betting on a game, like a Super Bowl, for example, I don't do sports. I'm so sorry, guys, but I'll just go with the Cowboys and the Patriots because those are the only two teams that I really know about. So if the Patriots, let's say Tom Brady's still with them, and they're at like 38-7, then obviously you have a better idea that the Patriots are going to win on the third quarter than you would from the beginning of the Super Bowl. So when you make a bet, you could say that there's odds for a bet, but the closer you get to the end, you kind of have an idea, unless there's a Hail Mary, which, I mean, there's been some Hail Marys with Tesla, because Tesla on last Friday, it dipped, it went up, it was doing a whole bunch of stuff. So some people can make some money within the last 2 minutes of time, but you have to sell real quick. So in that case, it's just that it's time value. A lot of people use that term because it's the closer you get to something, the more you're going to have an idea, an understanding of where the stock price is going to be at 4 p.m. Eastern.
Yeah, and to Chris' point, without getting too much in the weeds, his the closer you get, time's going to affect it. That's where Theta and Ivy Crush come in. So Brittany, to your question, but I don't know, Chris, if you want to get in the weeds on that, or if we should just leave it at that.
I would think just let's leave it at that first, because then maybe we can do a follow-up and talk about the Greeks and what that stuff means. I guess maybe just to get an idea too, volume and open interest, those are things to also take note on. Volume is basically how much was traded during that trading day. So if I'm going back to the 132, so I know I didn't even realize how many options were traded today for Apple, but I look at this so a trade is when someone sells it, someone buys it. And it's just kind of an everlasting loop. So, someone sells. So Dan, he sold an option, someone bought it, and then someone probably sold it. So that means someone else sold it. So it's kind of like passing the baton. It just keeps going, back and forth. So that means, now that doesn't mean that that's how many of these options are out there. That just means this is how many times it was traded. So this was traded today at 54,000. So that volume means that's a lot of volume. So what traders do is they kind of look at the volume, and they can be like, okay, yeah. I mean, look at the 130. There was more trading here than down here. But then also this is what's weird is these two right here, the 126, 127, these were lower than what the 125 was. Why is that? And so people can also research and see, well, maybe they saw that Apple was up and they wanted to take their profits. So maybe it was a hedge fund company that had maybe 2,000 of these. So they wanted to get rid of them. So, and that's when you can look at what's called level 2 data. You can look at other stuff. Open interest is basically how many cars are on the lot. So there are 94,000 of these shares or these cars up for sale or to be bought. So that means in terms of what's going on, this is how much was open. So there were more people wanting to sell this one, the 125, than the 124. I don't know why. So I'm thinking maybe just by looking at this, maybe someone was day trading the 125. I don't know what Apple was doing today. Oops. I don't know why I always do that. So it looked like it had an okay day. It was just, it was green. So it was at 128, shot up to 131. So maybe there's more people that wanted to get rid of them because of it going up so high. So those are just little tools or tricks to kind of see, okay, what's going on in the world. Kind of seeing the statistics behind some things. Now, that doesn't mean just because there's a lot of volume here, that doesn't mean I need to buy this, because there can be trap trades. They can be also people that are selling it, because remember, volume means buying and selling. There could be more buying and more selling on either end, and we don't have. Well, we can see some of the data. We can't see all of it. It's hard. I've been trying to work with that, but so you have to also be careful. And those are what's considered trap trades from some of the bigger guys. And by bigger guys, I mean the hedge funds, the companies, that the corporations that own corporate accounts that trade, because corporations and other, Intel probably owns AMD. they likely have, I'm sure they have tons of shares of AMD, because just because a company is against another one doesn't mean that they have large groups of people that are trading these accounts to make them money, to make them more money than what their competitors want to do. Just to give you kind of a little insight on some of the other stuff with that. Are there any questions? Oh, does volume follow price like stocks? It's similar, because again, volume just measures how much it was traded. So generally, if you see giant price fluctuations, you're going to see more volume. But then again, it really just depends on the stock. There's just too many examples to really cover. Like, for example, Plug, the volume was just insane today. It was close to 200 or 100 million, but the price fluctuation of it was just the daily range was huge. But then you could get other penny stocks that may have technically a lower range, a higher range, but lower volume. So it's up to how a trader really wants to look at it. I would just tell you what the tools, or just give you what the definitions are. Technical indicators for VWAP for options. Yes, there are. VWAP stands for volume weight action price. Is that what it is? It's one of those things.
Average price.
Average price, yeah. So that just measures the average price of where the stock is in terms of the volume, to give you a better sense of where it will likely be bought or sold at a price. Certain brokers and certain trading platforms can show options. So if I were to, I'm going to actually delete all this so you can see a better idea. Don't worry, I'll make it all nice and pretty. Oops, cut So if I just go to one chart, oops. So I know this is why I like Thinkorswim, is because it can do this. So if I click on trade and I click on Apple and I go back to my 132, if I right click, it will say copy and it has a code to it. Interactive Brokers uses it. You can use it on multi-charts. You can use it on third-party software like Sierra Charts. But I can copy and paste, and it can actually show me the actual price movement of this option. So if you don't even want to follow the stock price and just like a particular option and literally day trade an option, you could do that. Or if you want to look at the daily, you could do that too. And so then you can kind of get an idea. So just kind of going off on this question, can you use technical indicators on options? Yes, you can. It just depends on the broker. So with Thinkorswim, which is TD Ameritrade, if you can copy the option code, and you can see it's a long list of, well, I understand the number because if you look Apple and then it says 21, which would mean 2021, 01, January 15th, C is call 132. And you can see I have my, oh, this is the theoretical option price, so that's not it. But you can see here's the volume. So it will show you how much was traded for this particular one. I don't have the RSI loaded because I have mine differently. You could see the MACD. So you can see right here, which would have been on the 14th, or I'm sorry, the 4th. This is looking like it was going into a bearish or going down in price. So let me go back. So hopefully that answers your question. With Schwab, some of them I can kind of get the graph. I haven't figured it out, and the brokers I talk to, yeah, they assist me, but we couldn't really get a definitive answer on how to get it done. So I don't know. What about Vanguard? Do you know, Dan? Or do you have Fidelity? I forget.
In terms of what again?
For charting, for options, charting the options.
Vanguard definitely doesn't have good charting.
Oh, okay. So that's what kind of stinks, is there's not a go-to charting system and broker. It just stinks because the problem is it's just there's so many different traders. Schwab, I work for Schwab, they're great, but I see them more as a retirement investment company, or when you're trading just maybe some stocks, not really day trading options where things can, trade, or like if you were to buy this, like, yeah, you could probably get the price in, sell it tomorrow. If you think it's going to go, you'll be fine. Or Vanguard or Fidelity. But it just depends on your your investment needs. I know people in Robinhood, they like to day trade. So it's just what broker, or Webull. Yeah. So Webull has charting for options, is what Justin said. So I'm trying to experiment with all the different brokers so I can be kind of like the guru of, hey, I know Webull and Robinhood are things I have not looked into yet. I've been doing interactive brokers because it can link up to APIs and third-party charting software and then execute these orders through that software rather than having to click and do all this stuff. So that's just my personal preference.
Chris, is there any last minute questions for everybody? Because we're at time. So far, I'm just seeing just solids, but. Well, if you guys don't know, weekly update or the halftime show goes out for the newsletter this evening. Sometime tonight. Usually it's kind of around like 10 p.m. Mountain Standard Time. And obviously feel free to message any one of us, Chris, Dan, myself, or post it in the group, posting those questions in the group. helps everybody else as well. Is there anything you want to finish off with, Dan or Chris?
I just want to say thank you for being here and thank you for having me. And if anyone has any questions, they can just DM me or PM me on Facebook. It's Chris, CHRIS Haven, HAVEN. But yeah, so hopefully everyone can learn and enjoy, and we can all let's invest and trade together.
Woo.
I'd just say, if there's any topic you guys definitely want to hear about, let us know so we can.
Yes.
On that.
Yeah, we're trying to figure this out as we go, what works, what doesn't. If you enjoy it, so please let us know. Send us messages, let us know about topics for sure.
It's definitely my first time in here, but I would like to see, I don't know if you guys have covered it before, like speculatively, like long-term and short-term holds that you guys think, I don't know, whatever you guys have on your maybe portfolios or something like that. I mean, that's something that I want to hear from
Who we're
people.
playing personally.
For you guys, yeah, I mean, you guys definitely have way more experience than the majority of us, so I would love to hear what you guys have going on.
And I think Dan would be a good one to maybe next week, Dan, we can take a look at Dan's portfolio. That might help us all actually.
Happy to share. Yeah, I got certain sectors that I'm playing for this year based on various reasons, but I'm happy to share why.
Yeah. Dan's very insightful when it comes to any questions or anything like that. If you need technical analysis or anything like that, Dan's my go-to guy, along with charting and stuff like that through Chris. So use us, like reach out to us and ask us. If I don't know the answer, I'll direct you to one of the guys that does. But we're definitely here. Charting in the future, we could do due diligence basics. Okay, charting.
Yeah, I can definitely do all that. For me, things that I hold in my portfolio, I mainly have mutual funds with me. I mean, I could tell you some of the mutual funds, but I don't really do anything else. I just day trade these stocks. So, and futures. I have two separate accounts. One's just my retirement and then my day trading. And so, I mean, if you want my list of mutual funds, I mean, I'm kind of branched out through all the sectors. And also like a retirement, I think it's like retirement by 2050 and retirement by 2060. And they have, they list all their portfolio percentages. I know Connor and Dan, they follow the newsletter that's sent out by them, and also with Ken, and Ken also does really well on explaining what we're all holding and the reasons behind that.
Yeah, I'm subscribed to the newsletter. Pretty much everyone here, I'm assuming, is. And, I think the due diligence basics and charting in the future, I think that could all tie into like the short-term, long-term discussion if we go do, with that next week or whenever you guys have that.
Yeah, for sure. And for you guys also to know, Ken was a licensed broker. I was a licensed broker. And Dan, you were a licensed broker. So we have, a Series 7 and 6.3 or 6.6. So we have broker knowledge. It's just as brokers, if we were working for these firms, we can't give advice on what to do. So this is all basically speculative in regards to that. So I just want everyone to be aware. It's not a crystal ball. I wish we did. That'd be really cool. But it doesn't work like that, unfortunately, especially with me with oil last night, but we won't go into that. So, but anyways, is there anything else you wanted to add, Connor?
No, I think that's good. So yeah, Corey, we'll take it to heart for sure. I might message you this week just to be like, hey, what else would you like to see? Because I like when people share that stuff with us because we just want to know more and how we can help more. There's a lot going on behind the scenes. So a lot of us are very overwhelmed. Obviously, like I have a full-time job working for that company behind me. And I try to help out as much as I can, but the best thing you can do is just message me directly. I'll take any word of advice that you give me, whether it's constructive criticism, anything like that. And obviously we want to keep doing these. And so the more people that we get to come to these, the better. So I think next week we're going to try just an open Zoom link, not just sending it out to the newsletter subscribers. I think we're just going to post it in the group during the day and see if we hit that 100 mark. So we're going to try different stuff next week. So definitely try to be in next week, right at 6. I'll probably start it at like 5:50, the actual meeting. So feel free to jump in whenever next week.
Yeah, but Corey, that's a good topic actually. So I would love to talk about that.
Yeah, thanks guys. You guys are awesome. This is my first time in, but I'm definitely looking forward to like continuing this.
Awesome. We appreciate you for sure.
Yeah, and we definitely have a lot more things in the work. It takes time to organize stuff, so we'll make sure to get more of these out there, as you know, and whatnot, and be able to answer questions.
All right, guys. You everybody have a good night, and we'll see you on the trading floor tomorrow, huh? Let's make some money. See you guys.
Everyone.
All right, good night, everyone.
Bye.